The Genius Act is a game changer, not just for the US, but I think for the entire crypto industry. Because we know what happens in the US ultimately has a ripple effect across the world. So I would be hard pressed to believe that this was just some random legislation. I think this was a deliberate and well thought out move in order to boost innovation in US financial services while ostensibly keeping systemic risk in check. Hello everyone, welcome back to another episode of GRC in Focus. I'm your host, Asad Bukhory. Let me frame today's conversation. The entire crypto world is buzzing about the next bull run, and everyone's chasing those price bumps. But I believe we are missing the bigger picture, and that is regulators are tightening their grip. When you think about the real cost of regulatory compliance for digital assets, it's not just the expensive legal bills only. I think it's the opportunity costs that sometimes boards ignore entirely. I want you to think about the value that's not created or captured because your resources are primarily dedicated to understanding how to navigate unclear regulatory requirements rather than focusing on growth initiatives. No doubt, digital assets are reshaping finance, but I think we need to be able to navigate the regulatory landscape with a bit more clarity. So today I want to look at some of the new rules, like for example, in the US, we have the Genius Act, and here, the UK's proposed framework, how these are going to rewrite the rules for stablecoins, and what does that mean for fund managers and for issuers. First up, let's talk about the US. Just a couple of years ago, I think it's fair to say that the American crypto industry was persona non grata in Washington. And I'm sure you've heard CEOs talking about an absolute war on crypto. We heard things like Operation Choke Point 2.0. The regulatory framework was then hostile ambiguity at best, and even became known as regulation by prosecution. But if you fast forward to today, I think that landscape is unrecognizable. The official policy of the United States now is to promote the development and growth of lawful and legitimate dollar-backed stablecoins worldwide. We even saw a landmark legislation like the Genius Act, so that's the guiding and establishing national innovation for US Stablecoins Act, move through Congress with a bipartisan vote, 68-30, on the 17th of June. And that's a complete U-turn from May, when the bill was installed, which left the industry in limbo. The Genius Act is a game changer, not just for the US, but I think for the entire crypto industry. Because we know what happens in the US ultimately has a ripple effect across the world. So I would be hard pressed to believe that this was just some random legislation. I think this was a deliberate and well thought out move in order to boost innovation in US financial services while ostensibly keeping systemic risk in check. Let me explain. The Genius Act is setting up the first comprehensive federal framework for payment stablecoins in the US. This means exclusive authorization for permitted payment stablecoin issuers. So effectively, they are looking at licensing money creation, but outside the old school banking system. I mean, when you think about it, it's reminiscent of the 1800s when you had state-chartered banks issue their own notes. The difference now is that instead of individual banks backing their notes with specie or government bonds, we now have stablecoin issuers backing digital tokens, but with Treasury securities and deposits. But this creates an entirely new transmission mechanism for monetary policy. So when the Fed now adjusts interest rates, it's not going to affect only traditional bank lending anymore. It's directly impacting the economics of these quasi-monetary instruments that could eventually handle trillions in transaction volume. I hope that policymakers have fully explored and understood these implications. The Genius Act has a dual pathway system. First, you have federal regulation through banking agencies, and then secondly, you have state regulation for smaller issuers. These are typically issuers with a market cap of $10 billion or less. Now, for federal regulation, it's subsidiaries of insured depository institutions subject to existing bank supervision. And then there's a new class, federal qualified non-bank payment stablecoin issuers. These are regulated solely by the controller of the currency. Now, if a state-regulated issuers hits that $10 billion mark, they have to switch to federal oversight within 360 days. And if they fail to do so, they will have to stop issuing new stablecoins. So I was wondering, why did they come up with this $10 billion threshold? To be honest, I'm not sure, but if I had to take a guess, I think it's probably systemic risk. US regulators are creating a sandbox at the state level for smaller, more experimental issuers, while pulling potentially systemically important entities under stricter federal banking oversight immediately. But I think this threshold, I think that could create a very strong economic reason for firms to try to deliberately stay under that 10 billion threshold. Think about the regulatory burden and capital requirements that kicks in at federal level. I think many issuers might find it more profitable to either fragment their operations or maybe spin off subsidiaries, or try to figure out how to limit growth in order not to cross that threshold. So I worry that this could end up creating a more fragmented stablecoin market where you have multiple mid-sized issuers rather than a few well-regulated ones. And so, ironically, this might actually increase systemic risk rather than reduce it, because you could very well end up with more entities to monitor, more interconnections to track, and more potential points of failure. So I just hope that regulators did not inadvertently create an environment where staying smaller and less transparent becomes a competitive advantage. My main concern is compliance landscape is about to get more complex for firms as they grow. I think management need to think through the cost and the operational implications of moving from state to federal oversight once they cross that $10 billion mark, because that's a significant shift in the regulatory burden and in how much capital they will need. Now, the really strict reserve requirements are where things get interesting and, dare I say, expensive. Both regulatory paths require one-to-one backing with safe assets. The Genius Act explicitly lists approved assets. These are US coins, currency, demand deposits at insured institutions. You have short-term treasury securities. These typically have a maturity date of 93 days or less. You have certain repurchase agreements. You have money market funds invested only in these approved assets, and you have central bank reserve deposits. From my experience through the 2008 financial crisis, I will tell you that safe assets have a very funny way of becoming not so safe very quickly. Remember those AAA rated mortgage securities? They were considered safe until they weren't. Some of you will remember the Reserve Primary Fund. That was a money market fund that was supposedly the gold standard of safety. It actually broke the buck when Lehman Brothers collapsed. I think regulatory frameworks are only as good as their enforcement. So let's look at some of the enforcement provisions under the Genius Act. Now, I have to say there are some pretty serious enforcement powers. We're talking suspension or revocation of licenses for major violations. You have cease and desist orders, you have removal of individuals, and you have civil money penalties. If you get caught issuing stable coins without authorization, you're looking at $100,000 a day in fines. Yeah, that's $100,000 every single day that you are in breach. And there are also criminal penalties for false certification. Now, it's worth noting that payment stablecoins are explicitly excluded from securities law. The act is meant to kick in 18 months after enactment or 120 days after final regulations, whichever is sooner. Federal regulators have, I think, 180 days to come up with initial rules, allowing non-bank entities to issue stable coins, as long as they meet specific regulatory standards, has clearly got the market excited. Look at Circle. Their stock jumped 34% the day after the Genius Act passed. I assume that this is the market breathing some kind of relief. Now, whether this is relief that we have some sort of regulatory clarity, I don't know, because I am thinking that the barriers to entry are going to get a lot higher under these provisions, which I think will favor the largest players, not the incumbents. And this is a bit ironical because if you want to foster innovation, surely innovation is not going to come from the largest players. It's got to be the incumbents. But we've now created an environment where I think it's going to make it incredibly challenging for smaller issuers. If you look at BlackRock, you look at JP Morgan, and you look at Citi, they've been quietly building for several years in order to be able to take advantage of this act. Rob Goldstein stated that BlackRock's goal was to be the bridge between traditional finance and this alternate universe. BlackRock has already partnered with Circle to serve as the primary reserve manager for USDC, so basically lending their institutional credibility to one of the market's most important pieces of infrastructure. BlackRock has also launched Build, the first tokenized money market fund, in partnership with Securitize. So I think that's basically them signaling their belief that tokenization of financial assets is the next frontier. Now let's shift to the UK, where the FCA is taking a more calculated approach. The FCA published 2 detailed consultation papers laying out their proposed framework for stablecoin issuance and crypto asset custody. The consultation paper will close, I think, at the end of this month, so 31st of July 2025, and we are expecting final rules by next year. While the US seems to be rushing to enable innovation, the UK is methodically building a framework that seems to put stability first. But where I think fund managers could get caught off guard, the FCA is not just saying, here's some new rules on crypto. They are basically building an entirely bespoke regime that's going to layer on top of your existing CAS or MiFID obligations. So if you're already regulated under CAS or MiFID Pro, you're potentially looking at dual regulation, meaning additional reporting and potentially conflicting requirements. You will also probably have separate capital calculations, maybe stress testing obligations that will need to run in parallel. Now, I don't know what this will actually look like in practice until they publish the final rules, but I suspect that if you are currently operating under CAS, they are adding layers that are specifically tailored to crypto risks that, frankly, CAS was never designed to handle. For crypto asset segregation, the FCA wants assets held in bankruptcy remote trust structures similar to CAS, but no implied rehypothecation. So you cannot reuse clients' crypto without explicit consent. Under traditional CAS, there's more flexibility around pooled client assets, but not anymore with crypto. But where I think it gets operationally intensive is the wallet level segregation requirement. You need to manage and track crypto assets at the wallet or key pair level. So you're not just tracking, say, for example, client A has X amount of Bitcoin in your books. You need to know exactly which wallet, which public key addresses, and which smart contracts are involved. And so I think this is a significant departure from the more fungible concept of pool client assets that we are used to under CAS. And the record keeping requirements are not light touch either. They want public key addresses, they want smart contract links, they want chain of custody evidence. But I'll say get ready for blockchain level reconciliation that CAS never contemplated. Your daily reconciliation won't just be limited to checking cash versus ledger anymore. You will need to compare blockchain records. You will need to look at internal systems. You will need to look at third-party custodian statements. And you need to handle on-chain latency and block reorganization risks. You will also need independent reviews of smart contracts. And if you're doing custody via smart contracts, we are talking DeFi vaults. The FCA wants independent code audits. This is a completely new obligation under UK custody regulation. So for fund managers who are currently operating CAS models, this means that they will need to upgrade their tech stack significantly in order to be able to incorporate on-chain analytics and key management infrastructure. I would also expect some legal overhauls in relation to clarifying trust status of crypto asset holdings. And I expect that you will have some reconciliation tools that can map on-chain activity to off-chain books. So maybe think about integrations with the likes of Fireblocks and chain analysis, etc. I've been through enough regulatory implementations, so I can tell you, start thinking about how to structure your custody operations. Now let's move to stablecoin issuance. The UK defines qualifying stablecoins as those tied to a single fiat currency, aiming to keep a stable value by holding fiat currency and approved assets. Full reserve backing is non-negotiable, so 100% backed by liquid, secure assets. Think central bank reserves, high-quality liquid assets, government securities, with a strong preference for cash or cash equivalents. Compare this with EMIs, who can hold a mix of secure assets under safeguarding rules. For stablecoins, you've got a statutory trust over the backing assets, and they must be held by an unconnected third-party custodian. And there's also universal redemption rights. All holders, retail and institutional, must be able to redeem at par value in fiat by the end of the next business day. If you think about the operational implications here, if you're restricting redemption to B2B counterparties, so pushing retail to secondary markets, that model won't work under these proposals. I guess the disclosure regime is going to look something like the UCITS GIDS, but tailored for stablecoins. So think asset composition, redemption policies, liquidity risks, valuation methodology, all of this will need to be published. And you are prohibited from using backing assets as collateral or in securities lending. So if you're running a fund-backed stablecoin using tokenized short-term treasuries, you need to be asking yourself, can you restructure your SPVs and custodial architecture to meet these segregation and liquidity constraints? Now, let's talk about the new prudential regime, because this is where the capital and operational complexity really ramps up. The FCA is building crypto-proof as a modular regime that layers over correct-proof. For own funds requirements, they are using a structure that's similar to MiFID-proof. So that's, you have common equity tier 1 capital, you have additional tier 1 capital, and then you have tier 2 capital. But crypto asset holdings, including your own issued tokens, must be deducted from capital unless they are fully backed stable coins. Permanent minimum capital thresholds are going to be aligned with operational scale, but higher than current cash mandated buffers. The fixed overhead requirement and the key factors may apply depending on your service profile, similar to MiFID Pro, but with more flexibility under Crypto Pro. For liquidity, issuers must hold dedicated liquid assets separate from backing reserves. These aren't for ongoing operations. They are specifically to meet redemption flows. But there are new quantitative limits on concentration risks and group exposures to banking counterparties and service providers. So if you're already operating under MiFID Pro, you are potentially looking at dual reporting, dual capital calculations, and stress testing obligations, specifically for crypto obligations. Now let's talk about the governance implications, because I think this is where boards might get blindsided. Stablecoin firms will most likely get pulled into SMCR, so that means prescribed responsibilities for custody, reconciliation, and backing asset oversight. Certification requirements will now have to extend for risk as well as tech leads who are handling smart contracts or wallets. And stablecoin issuers will need to model redemption disruption, custodian failure, and on-chain protocol bugs. This means they will need enhanced scenario testing, board-level impact tolerances, and dependency mapping that goes well beyond operational risk frameworks. From an AML perspective, they will need to think about how to factor blockchain analytics to detect layering, dusting, and sanction wallets. Transaction monitoring infrastructure will also need a significant revamp. If you are already operating under CAS and MiFID Pro, given the structural shifts, primarily around how custody reconciliation, redemption, and capital are managed for crypto assets, I think it's very sensible for boards to mandate a readiness assessment. And bear in mind, the consultation closes on 31st of July, 2025. Let's talk about the new prudential requirements for crypto asset firms, because this is where I think capital, liquidity, and operational standards will really drive home some of these compliance costs. For stablecoin issuers, they are looking at what we call PMR, permanent minimum requirements of £350,000, or a fixed overhead requirement, which is 25% of your relevant annual expenditure, or a K factor requirement that is 2% of average stablecoins in issuance, whichever number is the highest. For crypto asset custodians, it's £150,000 in PMR, or 25% fixed overhead requirement, or 0.04% of your average assets under custody. Again, the highest of the three. They are also proposing a 3-tier capital structure. So common equity tier 1, additional tier 1, and tier 2. So pushing for a high proportion of common equity tier 1 capital, at least 56% of total owned funds. As for liquidity requirements, firms will need to hold a basic liquid assets requirement, which is 1/3 of the fixed overhead requirement, plus 1.6% of total guarantees provided to clients. Stablecoin issuers have an additional issuer liquid asset requirement to hold on-demand deposits to cover price risk in their backing asset pools. If you are an emerging manager, you need to pay attention here because, firstly, your compliance costs are significant, but I think on the plus side, this is going to weed out the marginal players, and this could very well create a sort of regulatory moat around properly capitalized and well-regulated issuers. I think the likes of Circle and Tether and whoever else manages to emerge from this regulatory gauntlet, I think they will end up with pretty strong, almost, dare I say, oligopoly-like positions in their markets. What these capital and liquidity requirements tell me is that both the US and UK regulators are basically trying to bankify stablecoin issuers. They are demanding the kind of financial safeguards traditionally applicable for banks, without necessarily giving them all the benefits or systemic support that comes with having a banking charter. So I think it's important that boards drill down on financial planning. They need to really focus on stress testing. I think management should be able to articulate very clearly how they have modeled what happens to their capital ratios if there's a sudden unforeseen redemption event or a big shift in market conditions that hits their reserve assets. And I also think that boards will need to understand clearly how that compares to their traditional financial counterparts. I think this is very important. Now, I expect that investors will probably look at this as some sort of market cleanup. Why? Because if you look at that 350,000 permanent minimum requirement for stablecoin issuers, that's not pocket change. The ability to meet these standards, I think this shows a level of rigor that really makes you different. So effectively, this becomes like a point of differentiation. Many investors we know got burned during the Wild West days. So this is an opportunity for issuers to build a reputation for being reliable and sound by proactively showing off robust compliance and ultimately attracting investors who prioritize what I call compliance alpha. That's keeping their capital safe and sticking to regulations. Now, I have to say, the UK's 2% KSII, so that's key systematically important institutions, capital requirement for stablecoin issuers seems higher than what we are seeing in the EU's MiCA framework. And I fear that this could accidentally push businesses and innovation to other places. So if you are a stablecoin issuer with, let's say, 5 billion in circulation, the UK's 2% key factor requirement means you probably need £100 million in capital just for this component. And that's before you even consider the PMR or FOR requirements. Now, compare that to MiCA's requirement, which are maybe more nuanced, but potentially lower for equivalent issuers. And you're looking at a significant cost of capital disadvantage for UK-based operations. And I think this directly affects the economics of where global coin issuers might choose to establish their operations and obtain their licenses. For institutional investors who are evaluating UK-based stablecoin issuers, I think this higher capital requirement will either get passed through in the form of lower yields or higher fees, or it could constrain the issuer's ability to compete on pricing with offshore competitors. The risk here is that we end up with a regulatory environment that's rigorous, but commercially unviable, which would push innovation and capital formation to more lenient jurisdictions. When you put the permanent minimum requirement and you put the key factor requirements together, I think the UK might actually become less appealing than places like Singapore or Hong Kong for crypto businesses who are looking to set up shop. So I think we could very well see businesses looking to exploit regulatory arbitrage. And again, I think this would undermine the UK's broader digital asset ambitions. And I think there's also the potential for market structure distortions. That 350,000 PMR for stablecoin issuers versus 150,000 for custodians. To be honest, I think that feels a bit arbitrary, and I don't think that necessarily reflect the actual risks involved. And so I think this could very well create high barriers to entry for smaller, innovative players, ultimately favoring the larger incumbents and possibly offshore stablecoin issuers over those that are based in the UK. But what really concerns me with these proposals is the operational complexity and the scalability issues. The backing asset composition ratio calculation, I find that to be quite complex. It requires 180 days of historical data and super sophisticated daily modeling. This is a huge hurdle for smaller firms. And I'm not sure. I think they will struggle with the technical and resource demands. New entrants also face a 90-day restriction period before they can even access expanded assets. And again, I think this creates an uneven playing field. And when you think about those daily reconciliation requirements, I think they are sensible, but that's going to be very intensive and expensive across different asset classes, currencies, and third-party custodians, etc. I also think that these traditional banking oversight models will start breaking down when you start dealing with DeFi protocols and cross-border blockchain operations. How do you reconcile holdings when your assets are locked in a smart contract, say on Ethereum, but your custodian is in Switzerland, and let's say your issuer is in the UK, but your users are global, right? The daily reconciliation requirement assumes a traditional custody model where assets sit in clearly defined accounts at known institutions. But what happens when stablecoin issuers start integrating with, let's say, automated market makers or yield generating DeFi protocols to optimize their backing asset returns? I think the regulatory framework has simply not caught up with the operational reality of how these digital assets actually move and generate value across borderless 24/7 blockchain networks. So I think ultimately firms will need to choose between operational efficiency and regulatory compliance. And I think that could limit the innovative potential of these new monetary instruments. I also find the practicality of the liquidity requirements to be somewhat questionable. The issuer liquid asset requirements look-through requirements for funds might be practically impossible for many to implement. And the framework doesn't even consider automated market makers or DeFi protocols, which a lot of firms deal with every single day. The requirements to hold deposits on demand, I don't think this aligns with how businesses operate in practice. Now, while protecting consumers is absolutely important, I worry whether some of these strict requirements might reduce the range of products and ultimately stifle financial innovation. I think it's very possible that we end up in a situation where only the big and well-funded players can afford the compliance burden, which, like it or not, I think will cut down on competition and could unintentionally push consumers towards less regulated and offshore alternatives. Take the ban on passing interest income to stablecoin holders. I think this removes a major revenue stream, which, if you combine that with the high compliance cost, might make the business model just not viable for smaller issuers. Now, let's talk about some of the blind spots that every manager needs to understand. First, you have the concentration risk in US Treasuries. So every major stablecoin is primarily backed by short-term treasuries, which means the entire sector has massive duration and credit exposure to the US government. So in a scenario where, say, treasury market is facing stress, and we've seen this before, we've seen this in 2022, we've seen this in 2023, I think stable coins could actually make volatility worse, not better. But if stable coins grow to a scale that some projection suggests, we're talking potentially trillions in market cap. So their collective behavior in treasury markets could destabilize the very asset they depend on for stability. Think about what happens during a market stress event where multiple large stablecoin issuers need to liquidate treasury holdings simultaneously to meet redemption demands. You effectively create a feedback loop where stablecoin redemptions drive treasury volatility, which in turn triggers more stablecoin redemptions as holders lose confidence in the backing assets. And we've seen similar dynamics in money market funds back in 2008, but I think the scale of potential stablecoin adoption could dwarf those historical precedents. The irony here is that the more regulators try to make stablecoins safer by mandating treasury backing, I think the more concentrated and systemically risky the treasury market might become. So we could end up with a situation where prudential regulation at the individual firm level creates systemic risk at the market level. And then secondly, these regulations focus heavily on reserve requirements, but I don't see them addressing operational risks. For example, smart contract bugs, blockchain congestion, Oracle failures. I think these are all inevitable risks. And if they materialize, they could very well trigger huge redemption runs. And then thirdly, you have this regulatory patchwork. So you have the US and UK moving forward with their own frameworks, but then you look at China, they've banned most cryptocurrencies because they're developing their own digital yuan. And then you have the EU with MiCA. This fragmentation will create regulatory arbitrage opportunities that I think sophisticated players will absolutely exploit. I can see how sophisticated financial institutions will establish issuance operations in the most favorable jurisdictions, say, for example, under US federal oversight or institutional credibility, while conducting their business through subsidiaries in jurisdictions with lighter compliance burdens. I think they might use regulatory differences to optimize their capital requirements, their operational costs, and their product offerings for different market segments. So for example, I think a firm might try to issue institutional grade stable coins under US federal regulation to capture bank and corporate treasury demand, while offering retail-focused products through EU MiCA compliant entities that can pass through interest income to holders. I think this jurisdictional arbitrage could very well create competitive advantages that the smaller and single jurisdiction players simply can't match. And so basically what will happen is we will end up concentrating power in the hands of some of the largest, most internationally sophisticated players instead of protecting consumers and maintaining market stability. Not to mention, this undermines innovation and competition, basically the opposite of what regulators claim to be pursuing. I also think that these daily capital and liquidity calculation and third-party arrangements will increase the oversight needed. Firms that are regulated by multiple bodies, because when you think about integrating with existing rules like MiFID Pro, that's going to add additional layers of regulatory complexity. And it's also not very clear what the specific escalation procedures will be where you have multiple requirements that conflict. I think in order for boards to be able to provide effective oversight, they will need to be able to cut through all the operational noise, and they will need to be incredibly disciplined about what information they need as part of reporting. And this will need to be very clear and concise. Now, if you are an emerging manager, you need to ensure that your investment thesis incorporates regulatory stress tests. This means modeling what will happen if there's a sudden unforeseen redemption event or a big shift in reserve asset performance. And you need to understand very clearly how does that compare to your overall fund's risk profile. I think these are some of the governance realities that the boards need to be thinking about right now. To wrap up, I think this regulatory clarity is clearly speeding up institutional adoption. I think Circle's IPO is just the beginning. I suspect we are going to see more and more IPO from other major players. So for emerging managers, your ability to navigate and leverage this complex regulatory environment, I think, is a very powerful story to tell to your LPs. So be prepared to explain in detail your fund's proactive approach to compliance. Talk about your internal frameworks for doing due diligence on regulated digital asset entities. Talk about your commitment to operational excellence, because I think this shows maturity and foresight. And it also addresses those big LP concerns about regulatory uncertainty. And I think when it comes to investing, you probably want to look beyond investing directly in highly volatile tokens. Instead, you might want to explore the pick and shovels of this new regulated ecosystem. You can look at, for example, RegTech providers that helps companies manage compliance efficiently without the massive overhead of enterprise solutions. So automated reporting, real-time monitoring, clear audit trails, etc. You can also look at custody solutions that address the FCA's compliance requirements. You can also look at scaling solutions. So these would typically be protocols that are being built for high volume, low cost, and offering institutional grade security. I think these are very interesting because they are real products and infrastructure that will support this regulated stablecoin ecosystem. And that's where I see the upside. That's all I have for today. If you have any questions, comments, or queries or ideas for new episodes, drop me a line at asad.bukhory@artisangovernance.com. And please share this with your network. I'll be back next week to tackle another challenge facing emerging managers with yet another fresh perspective. Until then, stay compliant.